Hello everyone, this is Riya Singh, the senior research currency analyst for Nirmal Bank. So let's look at what has happened into the forex market so far. So RBI came out with its rate hike of 50 bips, taking the policy rate to 5.4%. So this step was against what the market was expecting. The prognosis was of 25 to 35 bips, but it went against and went for a bigger rate hike. The explanation that the RBI has given against this big rate hike is that the inflation is still above the tolerable level, and in order to avoid any risk where the inflation shoots up, such a big rate hike has been taken into consideration. Now, the RBI also went forward with mentioning the CAT situation. Now, of course, the country is facing a widening of current account deficit. So this statement was missing previously in the statements of the RBI, but in the current policy meet, they have stated the issue, indicating that though the forex levels are at a good levels, it is they will be able to service the CAD, but even mentioning the CAD into the current statement indicates that there is some heat that is coming from the current widening of the current account deficit. Now, with pertaining to the Indian rupee, they have said that they'll continue to control the volatility of the Indian rupee, and it has been seen in actions also. We have seen Indian rupee turning from the levels where it tested 80 levels. So I think a continued support by the RBI will continue into the Indian rupee as well. So going forward, what will be the factors that will play in support of the Indian rupees? First, now if you look at the data that is coming from the US, the economy is already taking a recession hit. So if Fed goes for a milder rate hike, then we could see some appreciation that could come into the Indian rupee, because that will be followed by the central bank as well. But if Fed goes for a bigger rate hike, the same footstep will be followed by the RBI. Secondly, if you look at the crude oil prices, they have corrected quite a bit from the highs. So that is another positive thing for the Indian rupee. Thirdly, FIIs have become supportive. There is flows that is coming into the debt market as well. Some inflows from the 5G auction is also expected. So the inflows would also again help the Indian rupee towards the appreciation. Now, the factors that will work against is, of course, if the inflation today is the US inflation data. So if the inflation persists above 9%, that will be a very big red flag for the Fed. Fed has clearly stated unless it comes near their target level, they'll continue with the rate hikes. So even if there is some cool off that happens into the inflation numbers, which is 8.8% due to the correction that has happened into the energy prices, we are still expecting a 50 bips rate hike on the Fed part going forward. So that will translate into the strength of the dollar index, which has remained robust, taking into consideration the global turmoil that is happening. Adding to the global turmoil, there is also a situation of Taiwan, where the risk of US-China relationship deteriorating is also high. So all this global turmoil will put the safe havens on a stronger hold. Even the dollar index, which we have seen that it has turned around from the lows, and it has maintained a support of 105. So I think it will continue with that support. 103 is the max downside that we are seeing on the dollar index. I think it will continue on the rise towards 108, 109 levels going forward. Then the another factor that could play against the Indian rupee is the widening of the CAD. I think if you look at the numbers that we are seeing, the pace at which the current account deficit is rising, it could translate into the CAD widening towards 60 to 80 billion dollars by the year end, which is a very vast widening if something is not done towards it. Of course, if you look at the exports, they are still closed off, and the heavy imports at a costly prices what getting the CAD towards such an aggressive widening that is happening. Thirdly, I think if you look at the positive of the FIIs, now we have seen the FIIs lately buying, but the quantum of the buying that they are doing right now into the Indian market is not very efficient one, or that will make any considerable dent into the depreciation of the Indian rupee. If you look at the 9-month aggregate, $4.50 billion they have sold off on a monthly basis as an average you can pick up. But right now, even on a month-on-month basis, not $1 billion buying is happening into the Indian market. So from the past 2 months, they have turned positive. We have seen positive data in the July end week and in the first week of August, which is nowhere near $1 billion also. So still a vast difference need to be covered up for the FIIs to go to the level of the pre-pandemic level. But take into consideration the rate hike that is happening into the US market, the expectation of the market where the US will take it Fed rate. I think them turning completely positive into the emerging market and going with the pre-pandemic levels that we had seen will be somewhat of a far-fetched dream right now. So I think for the Indian rupee on a longer horizon, it could depreciate towards 81.25 levels, and 79 would remain a very 79 to 78.50 is what the support zone will be there. So I think buy on dips will be a very prudent strategy to go into the Indian rupee right now. So that is the forecast for the Indian rupee. Thank you for watching.